Hi, I'm Tom Dalton, and welcome to Tax Boot Camp. Today, I'd like to talk to you about the tax basics of forming a corporation under Section 351. So, let's just jump right in. Property transactions occur whenever anyone exchanges property, including cash, for other property. And that's exactly what's happening when a corporation is formed. The new shareholders are transferring property, maybe cash, inventory, land, building, into a corporation in exchange for stock. And whenever you analyze a property transaction, including a corporate formation, there are 3 steps you need to go through. First, calculate the realized gain or loss. Second, determine if that gain or loss is recognized. And third, if it's recognized, what is the character? Let's take a closer look at these 3. First of all, realized gain or loss is the fair market value of the property that you get in the exchange, less the cost of the property that you gave up in the exchange. That's the realized gain or loss. The math. Did you have a gain or a loss? If you have a realized gain or loss, the next question is it recognized? Recognized means, does it show up on your tax return? Section 1001 requires the recognition of all realized gains or losses unless there is a code section that exempts them. The default is recognition unless you find a code section that exempts it. If the gain or loss is recognized, then the third step is to determine the character or how the gain or loss is treated on the tax return. There are 3 types of characters. The first is ordinary, such as inventory, which is taxed at ordinary income tax rates. Second is 1231 gain or loss, which is generally the sale of property or fixed assets used in a business. It can be taxed at a variety of different rates. And if it's not ordinary or Section 1231, then the property falls into the catch-all group, capital. And capital gain or loss can be taxed at either ordinary or long-term capital gain rates. Let's look at an example of a property transaction. In this example, the person on the left is selling a car that cost $500, and he's selling it to the person on the right, which is buying it for $2,000. The person on the right sold $2,000 in cash and received the car. So what she got was a car that was worth $2,000 minus the tax basis of the cash, which is also $2,000. She has a realized gain of nothing, 0. The person on the left, however, received something worth $2,000, the cash. The cost of the property he gave up was $500. The difference between the two then equals a realized gain of $1,500. With a realized gain of 0, the person on the right is not very interesting, and we can stop right there. However, the person on the left with a realized gain of $1,500, that one we have to continue to the second step and determine if it's recognized. We know that gains and losses are recognized by default unless we can find a code section that exempts it. We cannot find another code section that exempts it. Therefore, the entire $1,500 is recognized and shows up on the tax return. The third step is, what is the character of this $1,500 gain? It wouldn't be ordinary unless he intended to sell the car as inventory to customers in a business. It wouldn't be Section 1231 unless the car was a fixed asset in an existing business. So therefore, it's most likely capital gain and taxed at capital gain rates. Now let's do an example of an incorporation. Here, Joe, who is a sole proprietor, transfers the assets in his sole proprietorship to a corporation in exchange for stock. To figure out the tax consequences to Joe, we're going to follow the 3 steps in evaluating a property transaction. So first, we have to figure out, what did Joe get? One thing Joe got was relief of debt. A minute ago, he owed $400. Now, that loan has been transferred to the corporation, and Joe doesn't owe it anymore. That's a benefit of $400. The second thing is the stock that Joe got. So we have to determine what is the approximate fair market value of the stock that Joe received. And if we look at the fair market value capital of the corporation, we can see that a reasonable person would probably pay $1,000 for the stock. The corporation has $1,400 of assets, but at the same time, the corporation has a debt of $400. The net of that is about a net worth to the corporation of $1,000. Summarizing that in step 1, we have to calculate Joe's realized gain. Joe gets $1,000 of stock. He also gets relief of debt of $400 for a total amount realized of $1,400. Minus the basis of all the assets he transferred to the corporation, that gives him a realized gain of $800. In step 2, we have to figure out whether Joe's realized gain is recognized. Remember, by default, all gains are recognized unless we find an exception in a particular code section. Here are some common exceptions to recognition of gain: sale of a personal residence, like-kind exchanges of real estate, formation of a partnership, none of which apply to us, but Section 351 on incorporations does. Section 351 says that no gain or loss shall be recognized if 1. Property is exchanged for stock in a corporation, and 2. The shareholders in that exchange are collectively in control immediately after the exchange of that corporation. What in control normally means is those shareholders own collectively at least 80% of the stock in the corporation. The non-recognition, however, does have limits. Section 351 also says that if a shareholder receives something other than stock in the transaction, then the fair market value of that other property will trigger gain to the extent of the realized gain that we calculated in step 1. In other words, if a shareholder has realized gain, as we calculated in step 1, and also receives property other than stock, that shareholder will have recognized gain to the extent of the fair market value of that other property, but no more than the realized gain that we calculated in step 1. We call this other property boot. So Section 351 can generally make an incorporation non-taxable, but if a shareholder receives boot, it's possible that that boot will trigger the recognition of gain. Note that receiving boot doesn't trigger anything if there was a realized loss in step number 1. Let's revise our example of Joe forming a corporation to include boot. In this example, Joe only has land as the asset, and he transfers it to the corporation in exchange for stock and $20,000 of cash. The exchange qualifies under Section 351 because it is property for stock, and Joe is in control of the corporation immediately after the exchange. So no realized gain is recognized except to the extent of the boot, the $20,000 of cash. The first thing we need to do is calculate the realized gain or loss. It's a fair exchange. Joe gets stock worth $100,000 plus cash of $20,000 in exchange for land that was worth $120,000. The realized gain is calculated by taking Joe's amount he received, $120,000, and subtract the basis of the land that he gave up, $10,000, to give a realized gain of $110,000. That's step 1. Now we need to do step 2 to see what's recognized. Section 351 applies because it's property for stock, and Joe's in control immediately after the exchange. So generally, there's no gain recognized, except for the fact that $20,000 of boot is received. So of the $110,000 of realized gain, $20,000 is recognized and $90,000 is deferred. The $20,000 of recognized gain will show up on Joe's tax return, and he'll pay tax on it. The $90,000 of deferred gain will be taxed sometime in the future when another event occurs, most likely when Joe sells the stock. But how do we keep track of this $90,000 of deferred gain? We keep track of it by adjusting the tax basis of the stock. We set the tax basis of the stock so that when Joe sells the stock later, he'll recognize the $90,000 of deferred gain. Here's how we do that. We have a formula for calculating Joe's new stock basis. It's the carryover tax basis of the assets he contributed to the corporation, plus any recognized gain, minus any boot received, minus any liabilities that Joe transferred to the corporation that were not already counted as boot, as you'll see later. All of this together equals the stock basis to the shareholder. Here's how we calculate stock basis for Joe. The carryover basis of the land is $10,000. He recognized $20,000 of gain. He received boot of $20,000. There were no liabilities, so that doesn't come into it. But once we do the math, we find that his stock basis is $10,000. If and when Joe sells the stock later down the road, that's when he'll recognize the deferred gain of $90,000. Let's say that later down the road, the stock is still worth $100,000 and Joe wants to sell it. So he finds a buyer and he sells the stock to the buyer for $100,000. Now, Joe has another property transaction and he's got to calculate his realized gain or loss on this. On the sale of stock, Joe received $100,000 of cash, minus his stock basis that we calculated of $10,000 gives him a realized gain of $90,000. In step number 2, we can't find a code section that exempts the gain on the sale of the stock from recognition, so by default, the $90,000 is recognized, and Joe has to pay tax on it. And the $90,000 of recognized gain is equal to the deferred gain from the stock incorporation. There are two formulas that are very important in a Section 351 transfer. The first one is to calculate the stock basis. That one we just looked at, and you can see that one on the left. The second formula is to calculate the corporation's basis in the assets that were transferred to it. That one is on the right. The calculation of the asset basis within the corporation is very simple. It's simply the carryover basis of the asset that was transferred plus any gain recognized. Let's take a look again at our example where Joe incorporates his business. In this case, what we've already looked at is the stock basis, which is carryover tax basis of the assets plus gain recognized, less boot received, less liabilities. And that equals $10,000 in our example. The second part of this is what is the basis of the land that was transferred to the corporation? And it's simply the carryover basis of $10,000 plus the $20,000 of recognized gain. This makes the basis of the land to the corporation $30,000. So let's fix our diagram to reflect these calculations. First of all, on the land, let's cross out the cost of $10,000 and let's type in the $30,000. Plus, let's rename it tax basis rather than cost. The other thing is, let's make a notation on the stock certificate that the tax basis is now $10,000. This is part 1 of a 2-part video on Section 351 and corporations. In part 2, I want to go through an example of how liabilities that are transferred to a corporation affect all these calculations. So if you're interested in that, take a look at part 2.